So I want to continue with this video talking about, again, the balance sheet. But this side, we're going to talk about the right-hand side of the balance sheet. Again, this right-hand side represents where the company gets money to buy things on the right-hand side. So the first component of this is referred to as liabilities. They are either current liabilities or non-current or long-term liabilities. By definition, current liabilities are short-term assets or short-term debts of the company. So in this case, they have to be, or they're supposed to be satisfied within 1 year or one operating cycle. Now, this is divided into three parts. If you kind of look at this part here, this is just the current portion of long-term debt that's owed this year. So it's you borrowed money for 5 years. This is just this year's portion of that 5-year loan. The accrued liabilities and deferred taxes, this is an accounting mechanism, right? It's what's referred to as the accrual basis of accounting. Almost all businesses run on this, and essentially this is just a way of taking into account those transactions that are short term that go from one accounting period to the next accounting period. So I don't want to get into a lot of detail about the accrual basis of accounting, but it is very short term, and there's just a couple of transactions that are recorded at the end of every period. When the next period starts, those transactions are then unwound. So they're not really economic transactions. They're just accounting tools, if you will. So the two things that we do worry about or want to take into consideration most of the time are what are referred to as accounts payable and notes payable. This is just short-term obligations that we recognize when we borrow money to buy things like inventory or office supplies. Now, the non-current liabilities are obviously have maturities greater than 1 year. We primarily are interested in long-term debt, right? These are either loans exceeding a year, or they could be corporate bonds that could have debt that extends to 30 years and beyond. These other things are obviously liabilities, but they are not directly related to operations of the company. Now, leases are certainly part of the company, and we will talk about that in some later videos of exactly how we account for or track lease obligations of the company. Now, stockholder equity is the last section, sometimes called shareholder equity. Sometimes that's actually referred to as net worth. But this is just the residual, right? This is what, if you look at the accounting equation, if you take assets and subtract all the liabilities, owner equity is what's left. It represents owner's share of the business, if you will. So since owners bear the greatest risk and benefit from the greatest rewards, right, you would hope that this owner's equity piece, first of all, was always positive, but you want to see that growing over time to represent growing ownership of the growing equity of the owners of the company. So what do shareholders get, right? Well, they don't get a fixed return, right? That's what creditors get. But they do get to vote, and they can benefit if the stock price goes up. Of course, they suffer if the stock price goes down. And of course, they can receive dividends. Now, dividends are declared by the company's board of directors. So this is not just upper management, but this is a layer above management that helps us manage the company from a more strategic perspective. Now, retained earnings is what's left over after profits. So every dollar that the company has earned, less any payments that are paid to stockholders. So this essentially is just a value of what we refer to as undistributed earnings. It's when the company makes profit, right? When they have earnings, some of that is distributed to the owners as dividends, and the rest is reinvested. So if you take whatever the retained earnings are in the beginning, you either add or subtract the net income, you then subtract dividends. That leaves us with the ending retained earnings for the company. Now, here's a picture of the accounting statement for this worldwide sports. And they have several transactions that they've made. They started off with $250 in cash. $100 of that was a loan from relatives, and $150 is the total of the remainder, right? So if they have $250 in cash, $100 is borrowed, the other $150 must have come from owner's equity. Now they purchased some things. They spent $140. 80 of that was inventory, 60 of it was fixed assets. If you notice, when we talked about this double journal entry system, you'll see that if the transactions are opposite the item, right, the equal sign here, then they're both positive, right? So 250 equals 250. But in this case, if you spent $150 in cash, you purchased assets with this cash. So that means what? 80 of it was inventory, 60 of it was fixed assets. Next, we sold $875 of inventory. $25 of that was accounts receivable. So that means what? This is a total of $900. $875 was cash sales, $25 was accounts receivable. Now, owner's equity is where we recognize profits and expenses. So in here we had what? $900 worth of sales. Wages were negative 190 here, so it's going to be the same number over here because that is an expense. Purchases, again, we bought some merchandise. 30 of it was inventory, right? 20 of it was accounts payable. So again, if you add those all up, we end up with our $350 expense item here for owner's equity. So how much did they sell? They sold a total of $900. $875 in cash, $25 in accounts receivable or on credit. What was the value of their merchandise purchases? Well, they purchased $360 here, but they also purchased $140 up here. So their total merchandise purchases, right, was this $360. But their total purchases was $500. How much did they borrow? Well, it's really kind of a loaded question. They borrowed $100 from relatives, but they also borrowed $20 on accounts payable. Accounts payable is an interest-free loan. So the answer is they borrowed $120 in these transactions, but only $100 of it is interest. Down here you see the interest payment was $10. So interest must be 10%. So let's continue on. The next thing we're going to think about is we're going to move from a snapshot. The balance sheet is a picture of the company at a point in time. The income statement and the cash flow statement represents what has happened over time. So they refer to them here as videos, right? But they really just represent all of the transactions that have happened in the last accounting period. So the income statement shows revenues and expenses and how they've changed owner equity. And the cash flow statement just gives us a detailed example or illustration of how cash has changed over the time period. And of course, one of the things we need to understand is that all of the line items, all of the statements that we discuss, they are all intertwined. They're all related to each other and connected one way or another. So one of the companies that we'll be looking at as we go through more and more of these videos will be following the Hasbro company. So obviously they're a toy company. So some of the names I'm sure you're familiar with are Monopoly, Nerf. They're a member of the S&P 500. They're listed on the NASDAQ exchange, right? So we'll be looking at their financial statements. So here is the balance sheet for Hasbro. Again, you can notice what? Current assets. Remember, this is the value of all the assets that they expect to expend within the next accounting period. This is an annual statement. So within the next year, they expect to use up all of these assets. And of course, one of the things we want to do as we look into further videos is how do we analyze what they've done? What is their financial position like? Their current long-term assets, if you would add all of those up, here you see that net plant and equipment has increased by $30. And their intangible assets, goodwill and intangibles, have decreased by 57. We also even have some other assets. We don't know what they are, but there are some other assets. Here's current liabilities, total liabilities, right? Stockholder equity at the very bottom. And what we notice is this is referred to as a balance sheet. So the total assets has to be equal to the right-hand side of the balance sheet, which is our total liabilities and stockholder equity or shareholder equity. So our goal in the next several slides is to talk about how we analyze these financial statements of a company. Look forward to seeing you in the next video.